Welcome to this explainer. Okay, so you want to build actual wealth, right? But without drowning in all that confusing Wall Street jargon. Well, today we are mapping out your wealth building journey step by step, taking you from a complete beginner to a totally confident investor.
Here's our game plan for climbing what we call the risk ladder today. We're going to cover the problem with doing nothing, 4 steps before investing, time horizon and risk tolerance, savings and bonds, index funds, and finally, individual stocks. All right, let's jump right in.
Part 1. The problem with doing absolutely nothing, or as I like to call it, the invisible thief. So imagine taking exactly $1,000 in cold, hard cash. You stuff it into a glass jar, twist the lid on tight, and literally just leave it sitting on a shelf for 10 years. Safe, right? Well, actually, no.
Fast forward a decade. That exact same $1,000, it now only buys you about $800 worth of stuff. Why? Because the average U.S. inflation rate of 2 to 3% has been quietly eating away at your money the whole time. So doing nothing literally means you are actively losing money. It's wild, but it's true.
Moving to part 2, 4 steps before investing. Let's build that foundation.
I absolutely love the initiative you're taking just by being here, but we really need to clear these 4 prerequisites first. Step 1, kill high-interest debt. Look, if you've got credit card debt sitting at 15 or 20%, trying to invest is basically like trying to fill a bucket that has a massive leak at the bottom. You've got to plug the hole first. Step 2, build a 6 to 12-month emergency fund so life's little surprises don't force you to sell your investments. Step 3, ensure a stable income. And Step 4, learn the basics, which, hey, you're doing brilliantly right now.
Part 3. Time horizon and risk tolerance. Time to set your personal rules.
Here is the absolute first vital question you need to ask yourself. How long can I actually leave this money invested? We call this your time horizon. Think about it. If you need this cash to, say, buy a house next year, it belongs in a totally different, much safer place than money that can just sit, compound, and grow for decades.
And the second question is, how much risk can I really handle? You've got to be brutally honest with yourself here. If your portfolio suddenly plummeted 20% next month, would you panic and sell everything? Your long-term plan is only going to work if your emotions can survive those short-term bumps.
Which brings us to part 4, playing it safe with savings accounts and bonds.
At the absolute safest, lowest rung of our risk ladder, we have high-yield savings accounts. These give you government-insured safety. They're highly liquid for emergencies, and right now, they offer a really solid 4 to 5% annual return. This is literally the perfect, secure spot for that emergency fund. It completely crushes old-school banks that are still offering practically 0.01%. Now, stepping up just one rung on the ladder, we find bonds. The most crucial thing to understand here is that a bond is really just a loan. You are lending money to a government or a company. In exchange, they promise to give you regular interest payments and eventually return your original money. So, for example, a $1,000 5-year bond at 3% means you get a super predictable $30 every single year, plus your $1,000 back at the end.
But bonds do have a bit of a catch, and it's called interest rate risk. Think about it like a concert ticket. Imagine you buy a ticket for $100. Suddenly, the band announces an even better show, and those new tickets are only $80. If you try selling your original $100 ticket now, it's going to be tough. Bonds work exactly the same way. If newer bonds come out with higher returns, your older bond just isn't as attractive, making it really hard to sell without taking a loss.
All right, part 5, growth engines, index funds and ETFs.
Now we're getting into the really powerful stuff. Instead of trying to guess which single company is going to win, what if you could just buy tiny slices of hundreds of companies all at once? The S&P 500 gives you a piece of the 500 biggest U.S. companies. The NASDAQ gives you the 100 largest tech companies. And because they're passively managed, meaning they just follow an automated list, they come with extremely low fees. You are basically placing a bet on the entire economy to grow.
You might be wondering, what's the difference between the two? Well, index funds are priced just once at the very end of the day. ETFs, or exchange-traded funds, trade in real time all day long. They're jumping up and down every second the market is open. So ETFs just give you a bit more flexibility to buy or sell quickly, acting a lot more like an individual stock.
To absolutely supercharge these growth engines, you pair them with something called dollar-cost averaging. This just means you invest a fixed amount of money regularly, no matter what the stock market is currently doing. Honestly, this is the ultimate set-and-forget strategy. It completely removes that dangerous panic of emotional investing because you're automatically buying in whether the market is way up or way down.
And what exactly is the reward for this patient, automated strategy? Well, historically, broad index funds like the S&P 500 have seen a 7 to 10% annual return, and that's after adjusting for inflation. While past performance doesn't guarantee the future, it definitely shows the incredible power of long-term patience when you just bet on the broader economy.
Finally, Part 6, the risk of individual stocks.
When you buy an individual stock, you are buying a tiny ownership stake in one single company. This brings high excitement, high volatility, and potential dividends. Don't get me wrong, it is super thrilling to root for one company and get a slice of their profits, but man, it comes with intense risk if that single company happens to stumble.
With individual stocks, you're going to face high volatility and sudden price drops. To do this right, you really have to dig deep into company data, earnings, and debt. And remember earlier when we talked about safety through true diversification? Well, to get that with single stocks, you'd have to manage dozens of them, which frankly is exactly the heavy lifting that index funds already automate for you.
Which brings us to our final, essential question for you to chew on. Are you trying to beat the market or simply grow with it? Take a second to reflect on everything we've covered today. Because for most beginners, letting go of the stress of picking individual winners and just growing with the market through index funds, that is the clearest path to wealth. Thank you so much for joining me on this explainer. I really hope this gives you the absolute confidence to start your investing journey today.